With David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello, I'm David Blain, and welcome to All Things Money. For the next 30 minutes, we're going to take an educational, stimulating, and hopefully entertaining look at issues affecting your money. We'll give you information and actionable ideas to help you create or maintain wealth and proceed into the future with a better outlook for your finances. The show is about you and your money, so if you have questions or comments, feel free to email us at allthingsmoney@dlblain.com or give us a call at 633-0107. We also encourage you to visit us on the web at www.dlblain.com. There you'll find lots of information on me and my firm, as well as archived copies of the show. If you happen to miss a week or you didn't quite catch something, feel free to go to www.dlblain.com and take a listen to the archives. Also, for people that send us a question in or have a comment, we'll go ahead and send you a copy of our free quarterly newsletter, The Financial Focus. Today we're going to wrap up our four-part mid-year update. We've been updating the stock market, the economy, and last week we started looking at the individual sectors of the economy and our outlook for those sectors for the rest of the year. And so today we're going to finish up the sectors by looking mostly at the consumer sectors versus infrastructure, the consumer-driven versus business-driven type sectors. That's going to be the main focus of today. So last week we talked a little bit about the PCE, or personal consumption expenditures, and they're important because they measure how much the consumer is spending or not spending. Most of the economic growth in America has been driven by the consumer, services and consumer goods as opposed to manufacturing. And so this is a very important thing to look at. One of the ways that we use PCEs is to compare them to what we call CapEx, or capital expenditures. CapEx is simply a measure of business spending in capital, such as furniture, fixtures, plant, equipment, things like that, what we call capital expenditures. And they're a good measure of how much business is spending. And when we look at recent expenditures, we see that the ratio of PCE to CapEx has been rising. That means that the consumer seems to be continuing to be able to spend and go up, while the CapEx expenditures have actually come down slightly. And this reflects an ongoing resilience of the consumer, but still a reluctance by businesses to spend. And so that's something important that we look at. More specifically, this CapEx drop, recent drop in the capital expenditures by businesses, really reflects a lag in industrial equipment. Is only up 0.9% from last quarter. Transportation equipment is up significantly, 34.2%, and information processing equipment and software is up by about 8%. Now, when we're talking about these increases in numbers, don't forget these are coming off of very depressed levels of negative growth. And they have quite a ways to get back up to the levels that they were before the financial crisis. The strength of the dollar and widening credit spreads could also be a short circuit on the recovery. They're negative for the industrial sector. On the positive side, the S&P retailing group typically goes up following the recession end, and we'll touch on that in a minute. The dollar rally and widening credit spreads, with the dollar appreciating and credit spreads widening, meaning that the spread between U.S. Treasuries and corporate bonds rising, is typically a neutral indicator for the industrials. We have been emphasizing this retail trade. In fact, just last week, we're moving the retail sector back to market weight from overweight. But typically, and this was the case this time, was retail has significantly outperformed the rest of the market following a bear market bottom. This is why we like to study history. By monitoring closely, we were able to take advantage of some of these improvements in consumer discretionary, and we're seeing some of the highest margins in 10 years. But once again, just last week, we feel that this outperformance by retail and consumer discretionary has reached an end, and so we're moving those sectors and industries back to market weight. In the consumer discretionary, the profitability ratios, we look at highest margin in 10 years. They had a gross margin of 34.2%, pre-tax margin of 7.9 versus a 3-year average of 3.3. And so those are the typical trends that we see from the bear market bottom. And once again, we feel like these ratios and the run of retail and consumer spending has peaked. When the expectations have been risen for the retail sector, has been a negative, significant positive for the sector. We see that the expectations have risen to a peak somewhere around April of 2010, and the latest data on the consumer on the expectations relative to the S&P, it looks like it's peaked and it's actually started going down, which is one of the reasons that we have removed our overweight to this sector. We also saw significant positive earnings surprises in the sector that typically lead to outperformance. We also look at relative strength of the sector versus the overall market. Once again, relative strength meaning, is that sector rising more than the market or less than the market? And when it's rising at a faster rate than the market, we say its relative strength is better than the market. Once again, we saw these the relative strength of the consumer discretionary sector peak in about April of this year, and we're starting to see a downtrend now in the relative strength of the consumer sector. And so we've moved that sector back to a neutral weighting. We also look at the beta of the subsectors, and the beta was very positive for the consumer discretionary following the bear market bottom. Once again, we feel like in the choppy market of the remainder of the year that you don't want to necessarily be in the high beta sectors unless you have an extremely high tolerance for risk. Otherwise, we're reducing the beta of our selections to try to mitigate some of the volatility of the portfolio that we see coming in the remainder of the year. Well, that brings us to our first break. When we come back, we'll start looking at business-driven sectors. For All Things Money, this is David Blain.